Crypto and precious metals markets crack lower over the weekend as markets digest news of a more hawkish than expected Fed Chair Walsh coming in June. Put skew explodes as investors rush for protection and dump upside calls. With massive long-term support not far away, expect more volatility near term. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave from FRNT. How's it going, man?
Yeah, I'm good, thank you. Yeah.
These crypto markets, huh? Ugh. They are looking a bit rough.
Yeah, it's funny when we had Adam Bryce on last week and he was like, let's sit on the fence. We could break one way or the other. Well, yeah. We broke lower.
We did. We did. And I was, I've been sensing that a 74K test was on the cards.
Yeah.
But I'm not sure we can't really say we've tested it yet, right? I think we fell short by a couple of thousand points on BTC.
Yeah.
About 76-ish we bounced off now.
No, lower than that.
Yeah. Okay. So we got close. So that level is the line in the sand. Like if 74K goes, then that opens up a whole load of pain. Lower.
But fun enough, over the weekend, like I kind of felt we might see a deeper dump to 68K. I for some reason I always think Bitcoin always goes to like 68, it's kind of, or
those levels are ingrained in your mind from the old cycle basically.
Yeah, exactly. It just seems to be levels.
But I remember ETH though.
Yeah.
Once it took out 28, oh my gosh.
Yeah.
Quickly to 22.
Yeah.
Right?
Yeah. No. Obviously, sort of
not
big
for the
moves.
faint-hearted. These moves.
No. Nor metals markets these days.
Yeah, I mean, silver had its biggest drop ever.
Yeah.
In one day, 35% drop last Friday. It was crazy. So what's the deal? Why are all these markets melting? Excuse me.
Look, I think obviously the big news from last week was the nomination of Kevin Warsh for Fed chair.
Is that so scary?
What's scary about it is he's and again markets react on knee jerks. He's a known inflation hawk. But importantly, I mean, ironically, he's a rate dove. He supports lower interest rates, but his kind of big thing historically has been in saying that he thinks he would favour a smaller Fed balance sheet. Okay. So his whole thing is really again shades of when Besant first sort of took over at the Treasury. The idea that we need to look at policies that are going to more benefit Main Street, not Wall Street, and his idea being that we should reduce dependence on the Fed balance sheet, i.e. less QE, less sort of money printing. If we reduce that, then that'll allow us to lower rates, and then lower rates can actually fuel private credit into the real economy to go to investment and productive uses. So we kind of instead of going for this sort of trickle down economics where if we inflate asset prices then that sort of feeds down into the real economy.
What, through wealth effects?
Through wealth effects, yeah. Actually that's the wrong way. We should have lower rates that fuel investment and productive investment and private credit that then drives the real economy.
Because the wealth effect only benefits the rich, right?
Exactly.
And the richest of the rich don't actually spend from that wealth effect because they're gazillionaires, right?
Yeah. So markets kind of had a bit of a kind of panic. Oh shit, he's going to come in and basically like again essentially pursue more quantitative tightening, tighten liquidity. He's happy to see asset prices lower, and that's what I kind of think there was that. I also think there was maybe a little bit of just bad timing in terms of I think gold and silver looked overextended in a way.
They were very overextended, so it didn't need much of a trigger to get a bit of selling going there.
Yeah. So I think all those things, that move was kind of underway, and then the Walsh stuff, and then gold and silver dumped.
Equities though, super resilient as always.
Yeah.
Right?
Yeah, like really took it in stride, which kind of made me think, it's not all about Walsh. It's a little bit gold and silver's got its own thing going on. Then you do worry about, that the kind of what we call a VAR shock, the value at risk, like when you have a big move like we saw in gold and silver, then that tends to be, again, like volatility spikes mean you end up having to de-risk all portfolios. And the question I was asking over the weekend was, how big is gold and silver in broader portfolios, that the required position reduction, how much does that feed into sort of broader like equity and crypto and all portfolios? And then the other thing, of course, is there's going to be a lot of leverage and stuff in those gold and silver markets that then require margin. How do you raise margin? Well, what can you sell that can raise margin? I can sell Bitcoin if I've got some. I can sell equities.
But they're chasing precious metals higher this morning. I mean, silver's up 10%, gold's up 5%. So it's just going to be very choppy, I think, right?
It's going to be choppy. The frustrating thing, I think, with crypto is that there doesn't seem to be any scenario where we trade higher or sustain. And again, I think that comes back to what we've spoken about. There's still this structural selling, right? So the weak side for Bitcoin.
Have all the OGs just thrown the towel in and said, you know what, this isn't what we thought it was going to be anymore. It's been polluted by the institutions. It's not this kind of freedom money anymore, basically. And that's the problem, that them throwing in the towels. There's just an endless amount of supply from people who bought it, before 2015 when it was trading sub 1,000. Is that the issue?
I mean, maybe. I mean, reasonably so. Or is it just we got to 100K that psychologically, that was a level that they might have had in mind. And also there's now, greater participation from institutions, there's greater liquidity. Is it like I can sell and I can sort of dump a few billion into this market and sort of get out of it.
But all the institutions who've participated or got into Bitcoin, they're probably all underwater now, right? Speaking of the biggest one, the biggest one everyone knows, Michael Saylor, right? I saw an article that said he's gone into the red by $1 billion or whatever it is now on a position that was so far in the money.
Yeah.
I mean,
but again, he's been scaling up, like as all smart
investors do.
And look,
when they're making loads of money.
Yeah, and look, there's going to be obviously all the FUD around that. But we also know that he's well financed in terms of, I think, into late next year, and he's raised dollars so he can meet interest payments. So the only kind of worry for Saylor is when interest payments come due, will you have to sell Bitcoin? And again, that's
and then will that have price impact?
Yeah, and that's not a story for today, but yeah, it won't stop people trying to. He's going to have to stop himself out.
He's
not. He bought more the other day.
He's not, but the market will push that narrative.
Yeah. And it's, I say, so we've got this kind of structural selling. When it's kind of risk on, you're kind of running into that kind of wall of selling, if you like. But then when it's risk off, then it kind of just acts with extra weight and everything's selling off. So it's kind of, there's an asymmetry at the moment, I guess, to the price in terms of it's hard work to really sort of build higher. But then the weak side is the downside, because that's where the natural kind of flow is at the moment. Now those flows are, as we've spoken about, are slowing. We need like a narrative, I guess, to bring new and fresh demand into the market.
I think we're struggling for that right now.
Yeah, and I just want to say on the Walsh thing, so like it's very, very different when you're in the seat to kind of how you act to what you say when you're not in that position. It's very easy to theoretically go, this is what I believe is how we should conduct monetary policy.
You have like an idealistic view on things.
Yeah. And one of my arguments is like the expansive Fed balance sheet isn't a policy choice; it's a necessity, right?
Why is that?
Because the system essentially in 2008 was bowed out, right? It essentially collapsed.
We didn't pay our dues, basically.
We didn't pay our dues, so they pumped liquidity in to inflate the assets that were the collateral underpinning the system, and that's the game that we're now in, right? And
so those assets are artificially inflated at prices they would never have been at.
Yeah.
Had there not been this backstop of insane amount of liquidity, right, from the powers that be.
Exactly.
Right.
And then you've got this deficit that is required, and not just in the US, everywhere. We require these ever increasing deficits to sustain growth, right? So and then when you're running these massive deficits, if you're not outgrowing the interest payments on that, then of course your debt's growing, and then who's going to keep financing that? And eventually the Fed become the liquidity provider of last resort. And we've seen this play out like just perfectly in terms of we had all this excess liquidity pumped in around over COVID, and the Fed went too far and kept QE too long and all this stuff. And then it turned up. Where did that excess liquidity? It turned up in the Fed's RRP, which we've spoken about. So that cash was over $2 trillion parked at the Fed. And then since the Fed have been doing quantitative tightening, trying to withdraw liquidity, well, it's been replaced by the money coming out of the RRP, and that's what's allowed markets and Bitcoin and everything to keep trading up. That hit zero basically in October, coincidentally, pretty much when Bitcoin topped. And then we started to see funding issues in the US funding markets, which is why the Fed then said, right, we're going to end quantitative tightening because there's not sufficient or ample excess liquidity in the banking system to fund it. And then they even went one further to say, right, we're now going to start up these reserve management purchases, basically buying T-bills and injecting 40 billion a month. Now that's not we're doing this because we want to inflate assets, or we're thinking of it as a monetary sort of policy transmission mechanism into the real economy. That's, if we don't do this, US funding markets will blow up because there's insufficient amounts of liquidity.
So the market's got a gun to their head.
So Kevin Warsh can go into the Fed and go, I think we should have a smaller balance sheet.
Good luck with that.
And the question becomes, all right, well, what replaces it?
Yeah.
And so what he'll do is he'll probably say, look, and I think Besant wants this as well. We want less dependency on the Fed balance sheet, but it's like, and then he'll go, but we're reducing the dependence from like duration on the Fed balance sheet, i.e., we're not going to be play a bigger role in longer out the curve, like 10-year plus type part of the Treasury curve. We will, however, maintain these purchases in the front end because we need that for liquidity. And again, it'll be dressed up around this isn't QE, this isn't like, but the balance sheet's increasing not because we're taking duration out of the market, but because this is just like I forget how they're describing it at the moment, but this is just like liquidity management. It's not, and it's like it's all the same thing. You're having to print money because we're running deficits that are unsustainable, and that will continue to feed the debasement trade. So I kind of think the markets have, and also, by the way, Walsh voted for QE when he was a governor, right? So like what he says.
My theory on like this narrative that Walsh is more hawkish than expected was that if they had announced a Fed chair who was considered to be an uber dove, then it would have been more likely that the bond market would have revolted on that. Yeah. And we've seen those wobbles in the JGB market, right? And what the with that kind of vicious circle where people are exiting your bond market, you have to then backstop it, but then that's bad for your currency, and then your currency dumps, and then your currency's dumping, so people are dumping your bonds, and it just keeps doing that. The US don't want that problem, right?
Yeah.
Because they've seen that problem in Japan, and they actually had to step in and kind of help them, right? So now it's like, isn't it better for the market to at least perceive the Fed chair as slightly more hawkish than expected? Because then at least the bond market doesn't have a reason to just go, okay, yeah, this guy's going to just cut and inflation's going to go nuts and we should be out of these treasuries, basically, right?
Yeah, exactly. And like, I mean, to your point, we've had these little wobbles where the market's gone, it's questioned the Fed's credibility. Yeah. Now it's a pick that the market is more credible. Now we're selling off that. Does that mean tighter policy?
And we're already having like dollar weakness in terms of like Trump coming in and doing all this stuff with Greenland and annoying allies essentially. Yeah. So then if they were to bring in another uber dove, that probably wouldn't be great for the dollar either, and the dollar just starts, the velocity of that down move in the dollar starts to accelerate basically.
Yeah, and it's the speed of it. I mean, Trump and Besant want a weaker dollar.
Yeah, but they don't want it to crash.
But they don't want it to crash. Yeah. So they just want this slow, and the rest of the world wants a weaker dollar. Yeah. So yeah, it's I think. Look, I think the market kind of panicked, and it probably came at a time when, say, the gold and silver and seeing those big moves, and it was kind of shoot first, ask questions later, a little bit of risk off. But I think we've stabilised quite well.
Yeah, on the options side, definitely hedging activity, right? I mean, as we blasted through those key supports, 88K on Bitcoin, 2,800 on ETH. We saw a big uplift in put skew. So I think ETH 1 week put skew got to about 17, which is about as high as I remember it for a long time. Okay, but we did have a pretty impressive move straight down 20% to near 2200. It has calmed down, but it's still gone back to levels where it was the week before when it was already quite elevated, right? So front end put skew still in that 8 or 9 region for puts. It's not at nosebleed levels that it was when we were at the lows, right? But yeah, right now the options market is, the vol's elevated as well. It's probably up about 10 points on the end of Feb expiry. It's probably about 10 points on both names. Ethereum's out realizing by about 30 points. So it's back to like moving the way it knows how to compared to Bitcoin. So very much a stressed options market, I would say. That is certainly not showing me any signs of positioning for upside, right? If anything, it's a defensive options market that is positioned more for more downside.
Are there any trades you like within that at the moment that stand out?
I'm not putting on any speculative longs right here. Before we cracked lower, because it felt like we were on a bit of a precipice with 2,800 and 88k. I did buy some more puts just to kind of protect because my hedge was quite light. Like I had a bit of a hedge on some of my Bitcoin, but I was like, you know what? I'm not really going to fancy a 20% drawdown if this thing wants to crack, even after the conversation that we were having with, Adam last week. So I was like, I topped up my protection by buying some February puts on ETH and Bitcoin. And then we have obviously cracked lower. Those ETH puts were amazing. They 5x'd basically in like a week. And I've rolled those puts to the at the money. So I've gone from 2,800 puts on ETH down to 2,200 puts. Those are my ETH hedges now. And then the Bitcoin hedges are still as they were because Bitcoin hasn't really cracked quite as hard. If Bitcoin cracks 74k and goes to like sub 70, then I'll have something to do on the Bitcoin puts. But for now, I'm kind of sitting pretty defensive myself, pretty well hedged, and really thinking to myself, unless we start to see some actual outperformance in crypto and some resilience relative to other assets, I'm not in a rush to like add longs here, basically.
Yeah.
know?
No, it makes sense. And I mean, like, not the biggest kind of technical guy, but again, when you just look at the technical setup, it does feel like it still wants to maybe break lower and test lower below that 70k. Again, that said, like within like my macro framework and the way I'm looking at the world, I think I've described why I feel like liquidity tightened, US liquidity at least tightened around, say, the RRP and alongside quantitative tightening and shutdown. That all came to an end in December. We've come into January. We're now starting to see the 40 billion a month just drip feed hit the market. So kind of in my mind, we've kind of reached the nadir in liquidity. And I think Bitcoin came out of the traps performing, and then we had the Greenland stuff, and now we've had the Walsh stuff. Also as well last week, I have to remember it was month end as well. So you had this kind of perfect thing of Walsh, gold, silver, month end, liquidity tightening. So again, and now you kind of into February want to see it bounce. I still feel like we've got the weak side is the downside. I don't know what's gonna be the catalyst to really draws like some real kind of demand in. It needs real demand to offset the kind of what I call like mechanical selling, which it feels at the moment.
And I would argue that I don't think we're going to see a low until we have a real bad crack lower, basically. Right? The sell-offs, whilst they haven't been fun, they haven't just been like
it's been like
utter
slow.
Yeah, they haven't been utter carnage where we used to see in crypto, right? Where it'd be down 20% in a day plus, right? I kind of feel like we need a move like that to put in a real bottom, right? But obviously it's going to be painful for people, which is why you want to make sure you know how to hedge yourself, right? Because if you don't know how to put hedges on, when I put those hedges on last week, I spent $3,000 on total on ETH and Bitcoin puts. And I said, if that goes to zero, I can live with that. I can write off that against whatever crypto pot I've got. If we rally over the next month and those go to zero, I'll make peace with it. But if we crack 30, 40, 50% lower because these long-term supports give way, I'm not willing to take a 50% drawdown on my pot, basically, right? And I think that's what people have to realize, that the risk is there of insanely large drawdowns, because that is the way. There's no backstop in this market, right? It's not like the Fed's going to come in to save crypto.
Yeah.
Right. So you've got to manage your own risk, and you've got to manage your own drawdown risk, right? And that's why there's a liquid options market for you to do it.
Yeah.
But instead of having FOMO about the rally, if we rally, there's so much upside that if you miss the first 20%, you don't care, right?
Yeah.
Because we could go 150K, 200K, whatever.
Yeah.
But right now, it's about preserving the pot that you've made. Say you got in 2020. Say you got into Bitcoin in the 15 to 20K region, and you saw it multiply by 3, 4, 5 times. You don't want to be giving all of that back.
Yeah.
If we get madness on the downside.
Yeah. And I mean, like the only backstop we do have is, again, finding levels where institutions and even WOWs and stuff go, right, actually this is me where I'm going to step in.
Institutions can be fickle, right? They can be like, oh, it's a great asset, I want to have some in my portfolio, and it's like, hang on a minute, it just drew down 50% in a month.
Yeah.
It's not allowed to be in my portfolio. I'll look like a moron if I buy it, basically, right? So that's the issue that we have with so much institutional capital now, in play, I'd say.
So I do feel like, because if I'm bearish, like, we're all fucked. But
it's true.
I do feel though, within my framework, I do feel like the US liquidity pulse is picking up.
I'll be more comforted by that when price action actually trades well on liquidity. Right?
Yeah.
Because whilst price action diverges from the macro, we have no anchor to say, okay, well, price action gives a shit about that, right? The dominant drivers right now are clearly not caring what the liquidity picture is doing.
No, yeah, exactly.
Right?
And again, because you've had this structural sort of selling, and that's why, and the opposite to that, you've had structural buying in gold, mainly from central banks. You've had, I still think, like, market was underpositioned equities from last April sell-off and was chasing that. So you've kind of had a structural demand story there. Bitcoin's been the other way on crypto. I do think with what the Fed have done and those changes, you start to see liquidity pick up. So I do think there's going to be more support. That again, let's see if that starts to feed through. The other thing yesterday, which I know there's been a lot of chat about on social media, we had the first positive or expansionary ISM manufacturing print yesterday. That was quite sort of blowout. Now again, I know people are like, you want to say, there's times when that expanded and Bitcoin sold up. In and of itself, it doesn't mean a lot. But I do think there's signs of the underlying US economy picking up. Because again, we talked about this K-shaped economy, right? Where a lot of it's been driven by AI CapEx expenditure. That's where the growth has. But actually, the kind of underlying US economy has been quite weak. And we've seen that in obviously in the labour market and whatnot. But if we start to see the impact of the rate cuts, but bear in mind, rate cuts act with like an 18-month lag. So if we start to see them feed the real economy, and also what some of Trump's been doing to kind of rebalance the economy, if that's a sign that the underlying economy is picking up, and this ties in with like Raoul Powell's stuff around like liquidity picking up, driving the ISM, and that tends to typically lead an alt season and can typically be good for Bitcoin. I think if there's signs that the underlying economy is picking up, which that would be the first kind of check mark on that, alongside a pickup in liquidity, alongside the fact that Trump and Besant are going to goose this market into the midterms, I'm still optimistic that we're going to see sort of Bitcoin back to record highs over the next 6 months, and altcoins sort of follow. So I guess the question is, and with what you're saying, does this market need one final flush that everyone's like, I'm out, and then we rebound higher, or can we put in a low around this 75K level, and then start to pick up? But we need to start seeing that price action. But I feel the conditions are there for it to happen. We just need that trigger. We need the flow.
We need the price confirmation, right? Like, for example, that's the beauty. If you know how to get leverage using options, you can be a bit late to the party. You don't have to catch the bottom, right? Like if we have a flush lower and then we turn and we go back up through 85K or 95K, whatever it is, you'll be able to buy call spreads with a target at 150K 6 months out that will pay you like 10 to 1.
Yes, you can,
basically, right?
You can get your returns.
So you can catch up on the fact that you haven't participated in the first 20-30% by the fact that you can 10x your money on a call spread if the rally is real, basically, right? Yeah. So anyway, I think that's a good summary. Lots for people to get their teeth stuck into. Let's talk about the guest that you caught up with this week.
Yeah, really interesting chat. Caught up with Eric Saraniecki from the Canton Network, who are...
Yeah, I don't know anything about them.
Yeah, so. I mean, they're building a proper network for the institutional space.
Perfect. All right, guys, check out what Dave and Eric had to say.
Welcome back to Crypto Options Unplugged, everybody. I'm delighted to be joined by Eric Saraniecki, co-founder of Digital Asset, who are the organization behind the Canton Network. Eric, thanks for joining us.
Yeah, thanks for having me.
Now, before we sort of get into the Canton Network, and I can't wait to sort of learn more about this, and I know it's very big in the institutional space. Would love to hear a little bit about your background. I know you've been in crypto for a long time, and it'd be great to just hear a little bit about your background and your path and what you've been doing in the space.
Yeah, I had a quick conversation with someone this morning. I don't know if I should be admitting how long I've been around. It's kind of a double-edged sword sometimes, depending on your perspective. But I started in the Bitcoin space pretty early, somewhere in the late 09, early 10 zone. And I've been pretty active in a bunch of different communities, directly hands-on, whether it was mining or running, different bits of infrastructure. Helped get Cumberland off the ground while I was at DRW. I spent about a decade at DRW, went straight down into the old fixed income and commodities pits pretty early on, paper sheets, fist fights, type of thing. And very quickly in the almost 10 years I was there, by the time I left, it was global event trading, microwave network, machine learning, automated trades, and, crypto trading. So that was a very rapid decade of change, that I got to ride the DRW roller coaster on, and left DRW in Cumberland in 2014 and helped get Digital Asset and Canton off the ground. So I've been in this crypto blockchain space for the better part of 15 years, and the preponderance of that has been spent at Digital Asset building out Canton.
Yeah, and what was it about Bitcoin crypto that really sort of drew you to the space?
Well, I don't know. I mean, there was a lot of misconception about it early days. There was a lot of kind of confusion, private internet money. In reality, it was completely transparent. I don't have a technical background, so a lot of this stuff kind of, I took it at face value. As the market matured a little bit, I saw that there was utility because people were using it in things like Silk Road, and so that had utility. I was not using it for that purpose, but that to me made it pretty clear how this could be an interesting sort of censorship resistant payment vehicle. So I just kind of, I guess I've always been drawn to countercultural stuff. So it just kind of, it just resonated with me, and I was, it was fun to be part of the very, very early club. I even got to, there was like a physical trading ring for Bitcoin early days down here on Wall Street. And I'd go there after hours and just kind of, relive the old days of trading in the pit, but for Bitcoin. So I think it was just kind of the early culture was really caught my attention, was a lot of fun. And it was, it just so happened that coincidentally to be a lot of my own personal network was involved early too.
Yeah, interesting stuff. And Canton Network, tell us about it. What was the thinking behind it, and what is it the Canton Network does?
Yeah, I mean, I'll answer it directly, but I try to give people a bit of an intuition first. I find that the best case study that we have as we think about these public networks is actually the internet. I consider it to be a much better and more instructive example for how public permissionless networks grow and why they're successful than if we look at something like Bitcoin or Ethereum. And, a few key insights there are that you really want to make sure that you have a heterogeneous ecosystem, that it's not just like a one type of app that does one thing, and that you get, if it's a level playing field and if it is truly disruptive, it doesn't universally mean that the incumbent loses. I would say like the more forward-leaning, aggressive, and smart and nimble incumbents can actually win a lot more, right? And if you look at someone like a chase.com, I would say that they have definitively benefited from having an online branch, just to kind of oversimplify what they've been able to do online. So if you take that as gospel, if you say, okay, at the end of the day, the internet it opens up for broader competition in different areas, and blockchains would do the same, or public blockchains would do the same. You'll have a mix of new winners, new entrants, challengers, but also incumbents. And so that's sort of very early recognition of that there is a space for incumbents, then forced us to say, okay, well, if they were to participate, what would it take for them to be able to join these ecosystems? What requirements would they have? What benefits would they enjoy? Because it's never just about like, hey, there's this new technology. It has to do something for somebody. And so we spent the better part of the early years of digital asset proving out what is the net new feature, what's the net new benefit, what are the hard requirements, what are the really difficult constraints that'll be on this ecosystem, and then making sure that the tech fit that. So kind of what I classically have called an inside out model, rather than starting with retail and doing like, let's disintermediate everything and use this decentralization and regulatory arbitrage to reinvent the world. More like, okay, what's the destination? Who's going to be here? How do they benefit? And make sure that the tech works for it. So all of the what I consider to be pragmatic design decisions around Canton are grounded in this firsthand learning of working with these large financial institutions to make sure that what we deliver has value for them. And I think that makes us eligible to be in the game. It means that we know for a fact that this can support what they need it to do. And I think that's a very big difference from the other systems, which are actively requiring regulatory changes to even be considered eligible. And even after that, I'm not so certain that the benefits are clear to all the participants. So I think it's all grounded in this sort of, I'd say, empathy for, the world ends up looking very heterogeneous at some point, and making sure that we design for that from the beginning.
Yeah, interesting stuff. So for those that don't know, what is it that Canton Network sort of doing? What are you solving for?
Yeah, so our thesis here is that the singular technological advancement in these public networks is composability. We've had every other thing, like when Satoshi and everyone else put all this together, the immutability, the tokenomics, it was an amalgamation of a lot of stuff that already existed. So the recipe was super innovative and very cool. I don't take anything away from it, but technologically there wasn't a lot of kind of new tech there per se. And when you look at the success of the smart contract networks, so much of it is being driven by, DeFi summer and everything that came out of that, which is built around composability, the ability for N things to be put together into one atomic transaction. It all happens or nothing happens altogether. And if you think about the way that finance works today, yeah, equities settle at the DTC, Monday to Friday, once a day in a batch. But there's so many other systems that hang off of that that have to be synchronized at the exact same time to be able to guarantee that settlement can take place. And so we already live in a distributed system, distributed ledger, but our sort of protocol of communication across all these different systems is Swift and fixed messages. And the consensus mechanism and algorithm is reconciliation. And so I see this as an opportunity to upgrade the messaging and reconciliation to be smart contracts and, kind of the consensus mechanisms of the network. So composability is the prize, and any solution that throws out composability, L2s, subnets, app-specific side chains, whatever sort of different terms you want to make up for them, is missing the whole point. And that's really at the heart of our design decisions, and one of the hills we'll die on. And the second one is privacy. And again, to the best of my knowledge, I don't mind being proven wrong on this if people have some good examples, but it seems to me that we are the only network on earth focused on privacy. You see a lot of people talking about privacy, but really what they mean is confidentiality or anonymity. And so if you look at kind of the options to someone today, there's really only two on the spectrum. One is everybody sees everything, Bitcoin, ETH, Solana, et cetera. And the other option is everybody sees nothing at all. And that's the entire zero knowledge and fully homomorphic encryption route. And that introduces a whole nother set of problems that I'm not even sure people are even looking for that sort of solution in what they're doing. And when we say privacy, we really mean specifically an asymmetric view on a piece of data. And it's exactly what everybody's already familiar with. I've used this example a few times, but Chase knows everything about chase.com. Every transfer, every API call, every holding, every user, they know everything. A user knows their account. They don't know anyone else's account. They don't know anyone else's information. Those two entities don't know anything about what's going on at Bank of America. And just because I have a browser on the internet doesn't mean that I get to know anything about any of those things. And so that sort of asymmetry is really important. And then it's not just the money at Chase, that money gets used in a bunch of purposes. So if you go back to the composability, if I want to pay my doctor with a Chase wire, I don't want my doctor to find out how much money I have in my bank account. I don't want the bank to know why I went to the doctor. So preserving that privacy when I spend it or when I compose it with other actions, it's a very complicated sort of set of views to get right, and then to build a system that can allow you to build, an application that can benefit from those features is a whole nother set of problems. So it's been a real journey for a decade, but global composability across a bunch of independent apps run on their own terms and their own systems and their own configurations with privacy, and preserving all of those core properties through all of those different applications is at the heart of our protocol design.
Yeah, that's really interesting. And where are you guys at the moment in terms of transactions that are going through the network, people that institutions that you've got onboarded? What does that look like?
Yeah, it looks great. I mean, we're off to a really healthy start. I'd say it's still very early, but we have a number of really large financial institutions that use the network and have for a while. Someone like a Broadridge is processing trillions of dollars of repo volume a month. But there's a lot of other use cases where they just haven't even disclosed any of this information to the network yet around natural gas settlements or life insurance policies, or there's a lot of really interesting alternative assets that are on the network. So the institutional adoption has been really fantastic. And a lot of what people are able to see in kind of more of a public setting is around a lot of the early wallet and DeFi ecosystem that's been coming and being built around the network as well. So I'm pretty excited about a lot of the things that are happening a little bit more openly that everybody can see. So it's not that stuff isn't happening, the privacy settings are different, right? Everybody can kind of configure what you get to see and under what conditions, and what bits of infrastructure that they use gives a different bit of a data to it. So there's no one size fits all, but there's a really vibrant ecosystem around things like trading, crypto assets, and there's a lending ecosystem that's starting to pop up, and there's a whole world of homegrown wallets side by side with all the household names like a Fireblocks and a BitGo and a Zodia and a Utila and everything else along those lines. So I'd say a really nicely rounded out ecosystem, especially over the better part of the last year, where this network motion has come in and complemented the institutional motion.
Yeah, and so even though it's kind of built around privacy and I guess this kind of interoperability between private chains, if you like, it can still interact with the public chains. Is that right?
So there's a couple things that I think you have to try to adjust your perspective on when you think about Canton. Often, because in every other network, you outsource your work to a pool of third-party validators. You point to that network and you go, that's the ledger. But in Canton, the ledger is your node. It's kind of like, what have I seen on the internet? It's my browser. What have I, stored from what I've done in this ecosystem? It's on my servers, right? So it's not like that's the internet over there, I'm going to that thing. It's really more my slice of that ecosystem is what I have on my devices. And that device on Canton, your node, your validator, can connect to all of these things simultaneously, right? So it's not like I'm on, the main net, and then I have a whole nother bit of infrastructure to connect to this specific L2, and I have a whole different set of infrastructure to connect to that specific L2, and actually my asset is here and that L2, and this, it's not like that at all. This is an asset I control, And then the infrastructure that you're using to synchronize those updates is kind of abstracted under the hood, and it's not necessarily relevant to you because your validator is your system of record and your system of truth. So it's more like, I have my bit of this ecosystem, I have my fragment of it that's relevant to me, and I am connected to all of these things. And all of these things may be heavily permissioned applications or totally permissionless applications. But from my perspective, I can compose transactions like that together. So if I had a counterparty and we were both onboarded into a, completely centralized, very locked down, very permissioned bond issuance platform, and my counterparty wanted to get paid in Canton coin for the bond, I could do that. I could create a transaction with a Canton coin for bond swap, and the whole world would see the Canton coin transaction because that's a bit of public information, and only the relevant parties would see the bond component of it. So it's like this. If I could call the APIs of two websites and guarantee the atomicity of that on the internet today, that's kind of the experience that we've been building for. It's not it's one network, even though physically segmented in all sorts of different ways.
Yeah, interesting. And how do you go about incentivizing these institutions to join the network and become part of that network?
Yeah, I think this is probably the area of design that we've benefited the most from everybody else's experience directly in the market already. So I think there's been a tremendous benefit for us to come with the incentives after, roughly a decade, a little bit less, of ETH and everything downstream of it being out in the wild. And, something that I have like a pretty firm point of view on, and is at the core of the thesis of the tokenomics of the network, is that really the tokens are supposed to align incentives with the right participants in the ecosystem. And there was a pretty large oversight in ETH, which is not their fault. Like, the way that they came to market versus what it has become over time has evolved a lot. But early days, my telling of the story, they were trying to be Bitcoin, but with smart contracts, right? They were trying to be as close to Bitcoin, but with just, instead of an opcode, I've got this smart contract delta. And over time, where they found product market fit is more as like an application ecosystem, as far as I'm, again, my version of the story. I don't know if they would agree with this. And the value of that network are the value of the applications in it. Yet 100% of the rewards of the network go to the validators. And that feels misaligned to me. It's hard to look at ETH and Solana and not recognize the tremendous amount of value that Tether and Circle provided to those ecosystems, or that Aave created, or Uniswap created. And when you look, those entities have not earned any mining rewards from the network for the activity of their assets or apps in those ecosystems. And what that has at least contributed to is the proliferation of application tokens. And that creates a really perverse incentive and really messes with the economics of something like ETH, because now, as an individual on the sidelines, if I want to bet on DeFi, do I buy Uniswap token or ETH token? And so we have a fragmentation of ETH's network effects, because physically, if you hit a certain throughput, you have to leave. So that's kind of obvious. You look at something like CryptoKitties, they had to leave and create flow. There's a lot of examples of L2s that got created because of the vertical constraints on ETH. So you're constantly physically shedding your network effects as an ecosystem. But I think potentially more impactful long-term is that they're also economically shedding their network effects constantly, because they're not rewarding the things that create the network effects in their ecosystem. So anyway, in Canton, the bulk of the mining rewards go to the users and applications that drive volume in the network. So if you're an Aave and you're responsible for, I'm making up numbers, 10% of the fees over the last 24-hour period, you'll earn 24% of the application rewards in the next period. And this concept is just very much like a dynamic, what's actually providing the utility in the ecosystem, and trying to align the incentives of those apps with the outcomes for the network. The vibrancy of the application ecosystem is directly attributable to the value of the ecosystem. So we tried to make sure that we came up with a new incentive structure, or relatively new. I'm not super aware of anybody that had done something exactly like this before. And it's all predicated on this idea of aligning the incentives of what we want to happen. We want assets, we want value, we want utility, we want things driving use of the network. And so we tried to design the incentives along those lines. We don't have staking because staking in a certain sense rewards inactivity, right? So I've taken something out of circulation. I'm not doing something. I'm delegating my efforts to a third party to run a server. They're getting the rewards versus here, something has to be active. Something has to get built. Something has to be driving fees in the ecosystem. And that's a really important incentive alignment. And the second, thing that I think is, very important in our tokenomics is that all of the fees are burned. So we employed something called a burn mint equilibrium function, which just effectively means every time there's fees in the network, it's not transferred partially to a validator. There's no priority fees that get given to the validators. All fees are 100% burned. So it's like all activity reduces supply to some extent, and that is universally beneficial to all token holders. And so it just really helps align everybody's incentives in the network, that everybody's is focused and driving more utility in the ecosystem. And that those two things together, I think, are pretty interesting divergent choices from the norm.
Yeah, that's interesting. And how, like, obviously I'm just thinking, I mean, there's been this huge, sort of push and excitement around sort of real world assets, and a lot of that seems to be being built on Ethereum. Yeah, how are you viewing that as kind of competition to what you're trying to build here? Like, do you think of real world assets coming onto the Canton network and over time out competing Ethereum, or do you just, will they just live side by side? What are your thoughts around that?
I mean, we have many multiples more RWA on Canton than they do in Ethereum. I'm using the royal they, it's not the ETH ecosystem themselves, but generally speaking, the ETH aligned ecosystem likes to say that what's on Canton doesn't count, and they keep creating these sort of like definitions of what it means to be on chain in such a way to exclude what's going on in Canton. I'm not going to get into the religious battle. My general perspective on this is that anything on chain counts because things get built in different ways to satisfy different requirements and needs and to get the right outcomes, and that there isn't a one size fits all. And so all these things should be considered side by side, but whatever, I'm not going to get into the religious waters on this. I think that even if I agreed that they were beating us in this regard, which I definitely don't, the transparency of assets on Ethereum is a benefit in the short term. Like, it's a really strong marketing benefit, right? Somebody coming out, issuing something, and then everybody in the world being able to know, wow, look at the growth rate on this thing, and look at where it's being used. It's a very useful bootstrapping mechanism. And I think that's not to be underappreciated, but it also puts an extremely low ceiling of utility on it as well. I think your partner Imran does a lot of derivatives activity, right? So imagine if you're in a regime where we're doing 24/7 margining, and we're doing a variation margin cycle every hour, and then you see every trading firm exactly what they're net delivering or receiving from the exchange. You know exactly what their vol position is in real time. I guarantee you can use that information, right? Or we have seen that when there are really large flows and stable coins into Mexico, that people front run the FX on it.
Yeah.
We know for a fact that people are not going to be willing to have their bank account details on chain. There's all these use cases that are being, touted as this is where the new growth is going to come, and this is the value of RWAs on chain, right? The money market funds and stable coins, the thing that everyone's talking about are corporate treasury management. Do you think that there's a Fortune 1000 company on earth that wants the whole world to see how they manage their treasury on a real-time basis? or how they do their international transfer pricing, or what companies they're funding, or what their net cash flows are in and out of different regions. Or if you're Google or Amazon and you go through painstaking hoops to make sure that you're not leaking what your GCP and AWS revenues are, now everyone can see in real time, how much compute people are paying for. I just think that these are clearly threshold issues. And it's not to say that stablecoins won't add value to that. They will. But if you don't have a reasonable approach for how to handle this from a privacy perspective, those are just the types of things that are non-starters. People will continue to absorb the friction because that savings is not worth leaking that information. Or like maybe something a little bit more germane to like the crypto native ecosystem. I know of a firm that helps manage the incentive programs for some stable coins, and they negotiate different deals with different entities. And when those payouts happen, they get angry phone calls because they see they got different deals. It's pervasive. Or if you're in Paris right now, you're worried about getting kidnapped. If you're in Iran or Venezuela right now, and you're holding stable coins or Bitcoin because what's happening in the local currency and the local is scared. Well, yeah, someone could show up at your door with a gun and take them from you. And I guarantee that the government knows who in their in their boundary has those assets. So it's just this privacy thing is a universal problem. And the reason that it's become topical recently is that the ecosystem is starting to get big enough where it matters. And when it wasn't big enough to matter, people kind of held their nose and just dealt with it. But now that these numbers are real, and now that stablecoins are pushing deeper and deeper into the real economy, these are material hindrances to adoption. And privacy is just one of many, but the most obvious right now, that will seriously interfere with getting from 300 billion to 3 trillion of stables in the next few years.
Yeah. Interesting. And in terms of, I mean, it kind of all just makes sense that all the finance is going to move to blockchain rails, the efficiencies and what have you from it. What in your mind are the timelines? What does that look like to that kind of full replacement of traditional rails? What are you thinking around that?
Full replacement of traditional rails? I don't know if that's an achievable thing. I mean, again, look at something as universally valuable as the internet. I wouldn't say that that's happened universally. There's still a pretty.
Yep.
So I don't think there's a world where, a lot of the infrastructure that we rely upon today goes away entirely. I think the better thing to be tracking is like, what are the flows that are going to happen in the near term that really hit an inflection point? And there, I think that there's roughly 3 categories that we track very closely and are a big part of our go-to-market motion. The first is cash on ledger. Cash is part of every transaction on earth, no matter what you're doing. Right? I'm buying a coffee, I'm buying software, I'm settling a capital markets transaction. There's a money leg involved in it. And so all forms of cash on ledger, stable coins, digital demand deposit accounts, cash equivalents like money market funds and sweep accounts, all the cash and cash equivalent stuff coming on chain is really, I think, a really big opportunity. And a lot of it has to do with the opportunity to increase the velocity of those assets. We haven't seen that happen to date. Generally, velocity of stablecoins is a lot lower than M1, but I think that the most important metric for us to track as a community is the velocity of money on chain. And that needs to be going up regularly. The second are what I call like extremely high utility collateral. US Treasuries, Eurobonds, gilts, JGBs, things that are the backbone of our collateral ecosystem, but also very under velocity from where they should be. A once a day, 5 days a week IM, the corporate treasury use case we were kind of dancing around a little bit before, being able to optimize my balance sheet and just in timing cash means I'm going in and out of, bonds. Global FX markets, I think, are going to be built on top of digital bond markets and the interplay between a bond and the cash market. So I think that the extremely high utility, high surface area of utility asset classes that are not sexy instruments and they're used at scale already today, but being able to provide this incremental opportunity is material. It is a very big opportunity. And then third, which is a very similar sort of thing, is like equities and that types of asset. I think, I kind of differ from most people. I don't think access is necessarily the opportunity for equities. I think more utility is the opportunity for equities. So lending markets and collateral markets, I think that that'll be really where the bulk of that growth comes from. It'll go hand in hand with an increase in activity in the spot markets because just naturally that they have to grow together. But I don't think it's going to be like access leading. I think it'll be collateral and lending that lead that opportunity. And then of course there's the long tail of alts and other stuff like that are all very, very interesting. But I think those three core asset classes that you could see, well, you will see trillions upon trillions of that landing in Canton this year at scale in meaningful ways. And I think that you could easily be into the quadrillions sometime next year.
Wow. And what I guess as we kind of draw to a close, what is the plans for 2026? What are you kind of really focused on? Just
those three things.
Yep.
At scale. It's
scale.
It's not rocket surgery, as we used to say. It's obviously way easier said than done.
Yeah.
Right? When you talk about these things, I'm not a payments expert, so I always tell all the kind of payments people in my orbit, like, please bear with me. I'm really sorry that I'm such an idiot on this topic. Things that seem so simple on the surface, like I want to move some money from myself to Dave. Under the hood is a unbelievably nuanced topic, and so to be able to do these things in the right sort of regulatory environment, to make sure that what you're doing enables the use case that you're going after, solves a real problem, you're working with the right participants and partners to enable that, they have the right infrastructure to make that happen. There's a lot of moving parts in all this. So I get really excited about, those times that you pull the thread all the way through the whole thing. And I've got every bit of infrastructure in place and every partner and every complement and everything ready to go. And from there, you'll learn a lot more about the future opportunities and where you can take it from there. So there's a lot that goes into it. These are not like one entity sales. They're often many, many multilateral type sale motions. But that's not to say that it won't happen very quickly, because the opportunity to these entities is very large. So
yeah.
There's a lot of momentum in this space already, and I expect that to accelerate rapidly over the course of this year.
Well, that sounds like a good space to good point to leave the conversation. Listen, Eric, thanks for coming on and telling us about what you're up to, and wishing you all the best for the year ahead. And thanks very much.
Thanks for having me.
All right, cool. So yeah, that was a really good conversation with Eric. They're doing a lot over there, aren't they?
Yeah, I mean, they're really. It's interesting now. In my mind, they kind of reverse engineered the, like, I've always said like crypto and traditional markets are going to need to like work side by side and together. And I think it's an interesting approach that Eric's taken in almost like reverse engineering. Instead of saying, right, here's these sort of public blockchains, how are we going to fit this world into it? It's kind of acknowledgement that, look, just given the regulatory constraints and what have you, they aren't going to be able to do that. And in fact, privacy is needed. And they're building.
Yeah, I guess it's like people who've got money want to stay private about it. Do you know what I mean? They don't want to announce to the world what they've got and like that sort of thing, right?
Yeah, and like all stuff obviously within banking, trading, like, the ability to front run sort of trades and things like that. If you've got a public network, that you can kind of essentially see what people
Everyone's
are doing. What people's positions are, cash positions are. So that privacy is important. And for me, again, it's just it's a reminder, like, we have all the stuff we get excited around crypto, but also the potential for this blockchain technology to transform finance. And
so you want the settlement, you want the instantaneous settlement layer part of it, but you don't want the kind of everyone can see what everyone's doing part of it, basically.
Yeah. You want all the benefits of blockchain technology. Without privacy is important. And they're solving for that. And
they're talking about tokenizing, kind of the more boring assets like your treasuries and your your FX and things like that, they were saying that that's probably what's going to grow a lot right, over the next sort of 12 months or so.
Yeah, and it's I mean, Eric's been in the space like for such a long time. It's just brilliant to see what they're building. And I know from an institutional side, there's a lot of people very, very excited about what the Canton Network are doing.
Yeah, I mean, I don't own any of it, but like I was looking at what the token was doing the other day. There's clearly a price divergence in what that's doing relative to the rest of the market. So clearly, I think they're the 25th biggest token on coin market cap right now. Yeah. So they only launched, I believe, in November, right? So like it's kind of quite interesting to see like the traction that they're getting. In such a short space of time.
I think as well, like I was thinking about this after I spoke to Eric. Like when there's so many comparisons like with crypto and .com and you know, we had the .com bubble and then everything kind of crashed and then from there started to emerge like the real use cases for these internet companies and that technology, and obviously emerging from that some of the biggest companies in the world today. I still feel like that's what crypto's kind of going through. Like we've been trying to find use cases. We found like the best kind of product market fit in terms of stable coins and people kind of quite comfortable. Like the payment space is a very obvious use case for crypto. But I think we're starting to see like networks and chains emerge that offer real utility and value. And that's we might well see a lot just kind of disappear,
fall by the wayside. Who used to be like up there in the rankings.
Right? And it's kind of refreshing to have a conversation like Eric, who's again building something with kind of real world utility. That's you can see sort of sticking around. So again, for me, it's just all part of the evolution of this space. And it's good to see
and lots of building still going on, right? Even though headline prices don't look great, but the building that's going on, I mean, you know, it's got to be good for the space.
What do we say? We'll end on this note. We're still early.
All right, we will end it on that note. Remember, guys, like and subscribe. We'll catch you back here next week.